The baby boomers, those 75 million Americans who spent the last 40 years telling everyone else to just work harder and save more, are about to hit a financial wall so hard that the impact is going to ripple through the entire economy. And I'm not talking about a small group of unfortunate retirees here. I'm talking about roughly half of an entire generation, 30 million people, who are simultaneously too old to keep working, but too broke to actually retire. The youngest boomers just turned 61 in 2025, which means the clock is ticking. And here's what nobody's saying out loud. This isn't just their problem. It's about to become everyone's problem. I'm gonna walk you through exactly how we got here, why the systems we built to prevent this are failing, and what this means for you, whether you're a boomer scrambling to figure out your next move or someone younger who's about to watch this unfold in real time. Because once you understand the incentive structures that created this mess, you'll see why it was basically inevitable. So here's the model I want you to keep in your head. Think of retirement planning like a three-legged stool. That's the metaphor financial advisors have used for decades. One leg is Social Security. One leg is employer pensions. One leg is personal savings. The idea was that if you had all three, you'd have a stable retirement. Comfortable, secure. The American dream, right? Except here's what actually happened. We sawed off two of the legs, set fire to half of the third one, and then acted surprised when people started falling over. Let me show you the numbers, because this is where it gets really interesting. According to the Peak Boomer Impact Study, commissioned by the Retirement Income Institute and authored by Robert Shapiro and Luke Stutkin, 52.5% of peak boomers, those born between 1959 and 1964, have total assets of $250,000 or less. Now you might be thinking, okay, $250,000. That's not nothing. But let's do the math on what that actually means. If you retire at 65 and live to 85, that's 20 years. 250,000 divided by 20 years is $12,500 per year. A little over $1,000 a month, and that's assuming you don't touch the principal, which of course you have to. So in reality, you're looking at spending down that entire nest egg. And when you factor in inflation, healthcare costs, and the fact that you can't actually live on $1,000 a month anywhere in America, you start to see the problem. Now, this is where most people say, well, that's what Social Security is for. And yes, technically that's true. The median Social Security benefit for these peak boomers is $28,400 for men and $21,400 for women. Notice that disparity. Women get about 1/3 less, which is a whole other incentive problem we could spend an hour on. But let's stay focused. So let's say you're getting the median benefit, $28,400 a year. Add that to the $12,000 from your savings, and you're looking at about $40,000 annually, which sounds almost manageable until you remember that the average monthly premium for Medicare Part B is around $200. Part D prescription coverage is another $40 to $50, and if you want any kind of supplemental coverage, you're looking at another $100 to $300 a month. So right there, you're losing $4,000 to $7,000 annually just to healthcare premiums before you pay a single dollar for actual medical care. And we haven't even talked about housing, food, utilities, or the fact that inflation has been running hot and nobody actually believes the government's official numbers. But now you might think, okay, this is bad, but people have been predicting Social Security doom for decades, and it's still here. And you'd be right to be skeptical, but here's the part that's different now. The boomer wave isn't a slow trickle, it's a tsunami. From 2024 to 2030, 30.4 million peak boomers are gonna hit 65 and start drawing benefits. That's a massive, sudden increase in the ratio of retirees to workers. And Social Security isn't a savings account, it's a pay-as-you-go system. The money coming in from current workers goes straight out to current retirees, which means when you have way more people taking money out and proportionally fewer people putting money in, the math stops working. The Social Security Trust Fund is projected to be depleted by 2034, which is less than a decade away. And when that happens, incoming payroll taxes will only cover about 79% of scheduled benefits, which means automatic cuts of 21% unless Congress does something. And if you've been paying attention to Congress over the last, 20 years, you know exactly how likely they are to make hard decisions about entitlement spending. Now here's the first leg of our stool that we sawed off: pensions. Back in the 80s, about 60% of private sector workers had a defined benefit pension plan. You work for a company for 30 years, you retire, and you get a guaranteed monthly check for the rest of your life. The company took on the investment risk. The company took on the longevity risk. You just showed up, did your job, and the retirement income was there. That was the deal. But companies looked at that deal and realized, wait, why are we taking on all this risk? Why are we making these promises that we have to keep for decades? And Wall Street came up with a brilliant solution: the 401k. Shift the risk to the worker. Let them manage their own investments. Cap our contributions. And we get to look generous while actually saving a ton of money on long-term liabilities. It was sold to workers as empowerment. You get control over your own retirement. You can pick your own investments. But here's the problem with that pitch. Most people are terrible at investing. Most people don't understand compound interest, asset allocation, or sequence of return risk. Most people just check a box on a form during onboarding and never look at it again. And the companies knew this. They just didn't care because it wasn't their problem anymore. So now, instead of a guaranteed pension, you have a 401k that might have $200,000 in it if you're lucky. And that $200,000 is supposed to last you through retirement. Except it's not really $200,000, is it? Because you're gonna pay taxes on every dollar you withdraw. And if the market crashes the year you retire, well, tough luck. You're selling low because you need the money to live. This is called sequence of return risk, and it's the silent killer of retirement plans. If you retire into a bull market, you're fine. If you retire into a bear market, you're screwed, and you have zero control over which one happens. Now let's talk about the second leg we sawed off: real wage growth. Here's a fact that's gonna piss you off. Real wages, adjusted for inflation, have been basically flat since the 70s. Productivity went up. Corporate profits went up. Executive compensation went way up. But the actual purchasing power of the median worker's paycheck stayed the same. Which means that while the cost of housing, healthcare, and education all exploded, people's ability to save for retirement did not keep pace. The classic advice was to save 10 to 15% of your income for retirement. But if you're making $50,000 a year and your rent is $1,500 a month, your student loans are $400 a month, your car payment is $300, your health insurance is $200, and you're trying to feed a family, where exactly is that 10% supposed to come from? The math doesn't work. And yet financial advisors kept giving the same advice because their incentives weren't aligned with helping you. They were aligned with managing assets. The more money you put into investable accounts, the more fees they collect. They don't get paid to tell you that the system is broken. They get paid to keep you in the system. This brings us to the psychological shift that nobody talks about. Boomers grew up in the greatest economic expansion in human history, post-war America. Pensions were standard. You could buy a house on a single income. College was cheap. The social contract was clear. Work hard, play by the rules, and you'll be taken care of. So they internalized that belief structure. They didn't question it because for most of their lives, it worked. But then, slowly, quietly, every piece of that social contract got renegotiated without their input. Pensions disappeared. Healthcare costs exploded. Wages stagnated. Housing became unaffordable. And instead of recognizing that the system had changed, a lot of boomers kept acting like the old rules still applied. They kept thinking, if I just work a little longer, if I just save a little more, it'll all work out. But it didn't. And now they're 65, looking at their account balances and realizing the math doesn't work. Now you're asking yourself, okay, but what about home equity? A lot of boomers own their homes outright. Can't they just sell and downsize? And yes, in theory. But here's the issue. First, where are they going to downsize to? Housing prices are high everywhere. If you sell your house in a high-cost area and move to a low-cost area, sure, you might free up some equity, but you're also leaving your social network, your doctors, your support system. And as you age, that support system becomes critical. Second, a huge number of boomers don't own their homes outright. They refinanced during the housing boom. They took out home equity lines of credit. They still have mortgages. And third, even if you do own your home free and clear, that's an illiquid asset. You can't pay your electric bill with home equity. You either have to sell, which is a massive life disruption, or you have to take out a reverse mortgage, which is essentially betting that you'll die before the bank takes your house. It's not a retirement plan. It's a last resort. Here's a concrete scenario. Let's call him Bob. Bob is 63. He worked for the same manufacturing company for 35 years. He has a 401k with $320,000 in it. He owns his home, current market value around $400,000, but he still owes $110,000 on the mortgage. His wife, Linda, worked part-time for most of her career and has about $80,000 in her own 401k. Combined, they have $400,000 in retirement accounts and $290,000 in home equity. Sounds okay, right? But Bob's health isn't great. He's got high blood pressure, early stage diabetes, and his knees are shot from decades on the factory floor. He wants to retire at 65. Linda's already 60 and wants to stop working. So let's run their numbers. $400,000 in the 401k. If they follow the classic 4% withdrawal rule, that's $16,000 a year. Add in Social Security. Bob will get about $26,000. Linda will get about $18,000. Total annual income, $60,000. Now, subtract their mortgage, which is about $12,000 a year. Subtract Medicare premiums and out-of-pocket healthcare, another $10,000. Subtract property taxes, insurance, utilities, another $12,000. That's $34,000 in fixed costs before they buy a single grocery. They're left with $26,000 for food, transportation, entertainment, emergencies, and everything else. That's tight, really tight. And if either of them has a serious health issue, if the market crashes and their 401k loses 30% of its value, if property taxes go up, if inflation keeps running hot, the whole thing falls apart. This is the reality for millions of boomers right now. Mock dialogue time. Imagine Bob talking to his financial advisor. So Bob, looks like you're in pretty good shape. You've got $400,000 saved. That's more than most people. Bob says, but Jerry, we ran the numbers and it feels like we're just barely going to make it. What if something goes wrong? Well, Bob, you could always work a few more years. Delay Social Security until 70. That increases your benefit by what, 8% a year? Jerry, my knees are gone. I can barely make it through a shift now. I don't have a few more years. Okay, well, have you considered downsizing the house? And move where, Jerry? Away from our kids? Away from our doctors? Silence, because Jerry doesn't have a good answer. The math doesn't work, and everyone knows it, but nobody wants to say it out loud. This is where it gets really interesting, because we're not just talking about individual financial failure. We're talking about a systemic issue that's going to create pressure on every part of the economy. When 30 million people suddenly have way less money to spend than they expected, consumer spending drops. When consumer spending drops, businesses make less money. When businesses make less money, they hire fewer people and pay lower wages. It's a feedback loop, and it gets worse. Because a lot of these boomers are going to keep working longer than they wanted to, which means they're occupying jobs that would otherwise go to younger workers, which suppresses wages and slows career progression for everyone behind them. And at the same time, some boomers are going to have to rely on family support, which means their kids, who are already struggling with student debt and high housing costs, are now financially supporting aging parents. It's a multi-generational squeeze. Let's talk about the role of market volatility, because this is the thing that doesn't get enough attention. The study mentions that as peak boomers turn 65, the value of their financial assets may not be stable and secure due to the impact of market volatility. And that's a very polite way of saying, if the stock market crashes right when you retire, you're toast. Let's say you retire in January of 2008 with $1 million in your 401k. By March of 2009, it's worth $600,000. You've lost 40%. And because you need money to live, you have to sell assets at depressed prices. You're locking in losses. And even when the market recovers, you never fully catch up because you had to spend the principal. This is why sequence of return risk is so devastating. Two people can have the exact same average return over 20 years. But if one retires into a bear market and one retires into a bull market, their outcomes are wildly different. And boomers, as a cohort, have no control over this. It's pure luck. And the incentive structure of the financial industry doesn't protect them from this risk. In fact, it exploits it. Because fund managers get paid based on assets under management, not on whether you actually have a successful retirement. If your account loses 40%, they're still collecting fees on what's left. Their incentives are to keep you invested, keep you trading, keep you paying fees, not to keep you safe. Now, let's add another layer. Defined benefit pension plans, the ones that still exist, are also in trouble. A lot of these plans are underfunded. Companies didn't put in as much money as they should have. They assumed higher investment returns than actually happened. And now the plans don't have enough assets to cover their liabilities, which means there's a real risk that even people who think they have a pension might see those benefits cut. This has already happened in some cases. Teamsters pension funds, coal miners pensions, cuts of 30, 40, 50%. These were promises made decades ago, and they're being broken because the money isn't there. And the Pension Benefit Guaranty Corporation, the federal agency that's supposed to insure these pensions, is itself underfunded. If a bunch of big pension plans go under at the same time, the PBGC doesn't have enough money to cover everyone, which means retirees who thought they had guaranteed income are going to get a fraction of what they were promised. So to recap where we are, Social Security benefits are going to get cut unless Congress acts. Most people don't have pensions anymore. The people who do have pensions might see them reduced. 401k balances are insufficient and vulnerable to market crashes. Home equity is either unavailable or requires massive life disruption to access. Wages have been stagnant for decades. Healthcare costs keep rising. And 30 million people are about to retire into this environment all at once. Now, here's the kicker. The financial advice industry spent the last 40 years telling people that if they just followed the rules, everything would be fine. Save 10%, invest in index funds, diversify, rebalance annually. And for the top 20% of earners, that advice worked. They had enough income to actually save 10%. They had employer matches on their 401k. They had stock options and bonuses and real wage growth. But for the median boomer, the ones who were making $50,000, $60,000, $70,000 a year, working jobs that didn't have big raises or bonuses, the math never worked. They couldn't save enough. And instead of the industry saying, hey, the system's broken, we need policy changes, they just kept blaming individuals. You didn't save enough. You spent too much. You should have started earlier. It's classic victim blaming, and it obscures the real problem, which is that we dismantled the systems that actually worked, pensions and strong social security, and replaced them with systems that shifted all the risk onto individuals who were never equipped to manage that risk. Let's do one more scenario to make this concrete. Meet Susan. She's 64, divorced, worked in retail management for 30 years. Her 401k has $190,000. She rents an apartment because she could never afford to buy a house. She'll get about $19,000 a year from Social Security. Her 401k, using the 4% rule, gives her $7,600 a year. Total income, $26,600. Her rent is $1,400 a month, so $16,800 a year. She's got $7,800 left for everything else. Healthcare, food, utilities, transportation, everything. That's $650 a month. She can't retire. She literally cannot afford to stop working. So what are her options? She can work until she physically cannot anymore. She can try to find a roommate to split rent, which at 64 is not exactly appealing. She can move to a cheaper city, away from everyone she knows. Or she can hope that something changes, that Congress fixes Social Security, that healthcare costs come down, that rent stabilizes. But hoping isn't a strategy, and nothing in the incentive structure suggests any of those things are going to happen. Here's the second comedic cutaway. Imagine a financial seminar from 20 years ago. Guy in a suit with a PowerPoint. If you just save 10% of your income and invest in a diversified portfolio, you'll retire a millionaire. Cut to 2026. Same guy, now older, same PowerPoint. So, about that millionaire thing, turns out inflation was higher than we thought. And also, you needed to save like 25% and also maybe have a pension. And also hope the market doesn't crash when you retire. But other than that, solid plan. Now, to be fair, not every boomer is in this situation. There are plenty who saved aggressively, who had high incomes, who got lucky with stock options or real estate. But the point is that it shouldn't require luck. The system should be designed so that if you work full-time for 40 years, you can retire with dignity. And we had that system. And we deliberately dismantled it in favor of a system that benefits corporations and financial institutions at the expense of workers. So what does this mean for you if you're not a boomer? If you're in your 30s, 40s, or 50s, you need to understand that the same forces that screwed the boomers are still in play. 401ks are still the default. Pensions are still gone. Wages are still stagnant relative to costs. Social Security is still projected to run out of money. The only difference is you have more time to adjust, but you have to actually adjust. You can't just follow the traditional advice and hope it works out, because we've now got a 30 million person case study showing that it doesn't. And if you are a boomer in this situation, I'm not going to sugarcoat it. Your options are limited. You can work longer if your health allows. You can aggressively cut expenses. You can try to generate additional income through part-time work or gig economy stuff. Though at 65, driving for Uber isn't exactly ideal. You can explore whether you qualify for any additional benefits, Medicaid, food assistance, housing support. You can have hard conversations with family about financial support. And you can advocate politically for policies that actually address this. Expanding Social Security, reducing healthcare costs, protecting pensions. But individually, there's only so much you can do when the system is designed to fail you. Let's talk about 3 specific, non-generic takeaways. First, if you're still working and you have access to a 401k, you need to be maxing out your contributions if at all possible, especially if you're over 50 and eligible for catch-up contributions. The limit for 2026 is $23,000 plus another $7,500 in catch-up, so $30,500 total. I know that sounds like a lot. For most people, it's not feasible. But if you can get anywhere close to that, do it. Because the tax-deferred growth is one of the few advantages you have. And if your employer offers a match, you're leaving free money on the table if you don't at least contribute enough to get the full match. Second, you need to have a realistic withdrawal strategy that accounts for sequence of return risk. The 4% rule is a guideline, not a guarantee. If you retire into a bear market, you might need to reduce your withdrawals to 3 or 3.5% for the first few years to avoid depleting your principal too quickly. Or you need to have a bucket strategy where you keep a few years worth of expenses in cash or bonds so you're not forced to sell stocks at the bottom. This requires planning and discipline, and ideally working with a fee-only fiduciary advisor, not someone who's getting commissions on products they sell you. Third, delay Social Security as long as you can. I know the temptation is to take it at 62 because you want the money now. But every year you delay between 62 and 70 increases your benefit by about 7 to 8%. If you can afford to wait until 70, your benefit will be 76% higher than if you took it at 62. And Social Security is inflation adjusted and lasts for life. It's the closest thing to a pension that most people have. So maximizing that benefit is one of the most powerful levers you can pull. If you need income before 70, draw down your 401k first and let Social Security grow. Now, let me bring this full circle. The boomers are in big trouble because we built a retirement system that was designed to fail most people. We replaced guaranteed pensions with market-based gambling. We stagnated wages while exploding costs. We underfunded Social Security and then acted surprised when the math stopped working. And we let the financial industry profit from all of it, collecting fees whether people succeeded or failed. The boomers believed the promise. They played by the rules. And now, as a generation, they're facing a retirement crisis that's going to reshape the economy for decades. But here's the thing. This was predictable. It was predicted. The incentives were clear. Companies wanted to cut costs. Wall Street wanted to manage more assets. Politicians wanted to avoid hard conversations. And workers, individuals, had no leverage to fight back. So, the system got rigged. And the people who are paying the price are the ones who had the least power to change it. And the cynical final line is this. In 20 years, we're going to be having the exact same conversation about millennials and Gen X, unless something fundamentally changes. Because the system didn't get better, it got worse. And hoping that people will just figure it out on their own is not a policy.